So it's a very good trade for individual investors. It's what I call an asymmetric trade. I mean, no guarantees, but the downside is limited because of the central bank demand, but the upside is unlimited because central banks are going to keep buying. Eventually, we'll get to the frenzy stage. We're not there yet. One thing that's really interesting is there's been a lot of talk recently about the strong dollar, and the dollar has been very strong. So, the euro got down to like $1.02. It's back up to about $1.04, but that's way down from $1.16 where it was not that long ago. The Chinese yuan is collapsing. It's blown past. It was kind of 7.1 for a very long time, and it blew past that. It's like now 7.3, getting close to 7.4 to the dollar. Swiss francs. You go through all the currencies, Japanese yen, etc. So we're seeing a very strong dollar, and usually, often, I should say, that's inversely related to gold. If you think of dollars and gold as competing forms of money or stores of wealth, and when people say gold, they're talking about dollars. I mean, we're looking at the chart, okay, 28.10 per ounce, and not that long ago, 2,000 per ounce. So that's a 40% increase over the course of the last year, which is spectacular. But we're always quoting the price in dollars. $2,000 an ounce, 2,800 an ounce. I think it'll get to $3,000 an ounce sooner than later. But we're really set when we say dollars per ounce, we're talking dollars. So when the price of gold goes up, you can just as validly say, well, yeah, but the value of the dollar is going down. It costs more dollars to buy an ounce of gold, so the dollar is worth less in terms of gold, and that's true. But the dollar has been strong in terms of other currencies. What does that mean? It means that those other currencies are falling even faster. You need even more euros and yen and Chinese yuan to buy your ounce of gold. So one way to think about it is that if you look in currency space only, put gold to one side, just look at currency space, the dollar's leading the pack. It's like a horse race, and they're coming down the stretch, and the dollar's got a big lead, and the lead is widening. The dollar is very, very strong. But if you take all those currencies and as a basket and compare them to gold, gold is going up against all of them. It's going up against dollars, but it's going up even more in terms of euros, yen, yuan, and Swiss francs, and all the other currencies. So we live in a funny world where we have a strong dollar, that's clear, but gold is also strong in terms of dollars. So it's not a straight inverse correlation between gold and dollars. It's like, no, dollars are running away from the other currencies, and gold is running away from dollars, and gold is very, very strong at the moment. I expect that to continue. The reasons for it are that, kind of first week of economics, what do you learn? Supply and demand. So what's the supply? Well, mining output has been flat for about 5 years. It's not crashing. I'm not talking about peak gold. I'm not saying there's no more gold coming out of the ground. There is, but globally it's been flat. Demand is going up, mostly coming from central banks. We're not at the stage where I talked to one of the top private gold dealers yesterday. He said that his retail customers are selling gold because they need money. There are a lot of different forces in the economy, Matt, and you're like, gee, isn't this a great time to buy gold? Well, I think so. Although we were recommending it at 1,300 an ounce and 1,500 an ounce and 1,800 an ounce. We recommended it all along. Now it's at $2,800 an ounce, so that's worked out extremely well. But it hasn't been a frenzy. It hasn't been, panic buying, at least at the retail level. And my dealer friend, who's very plugged in, he's a physical dealer, not some kind of Wall Street trader, said that people are basically selling him gold. He buys it and stores it and sells it later. So he's a dealer in that sense. But he said a lot of customers have been coming in. I talked to him about certain kinds of gold coins I'm interested in. I talked to him a couple of years ago. He said, Jim, I can't even find them, and the commission's huge. And I said, is that still true? He said, no, I got a lot of them. And, commissions are down, they've been like 15%. He said commission's down like about 6%. So that was interesting. And he said the men had stopped making them for a while, and now they're back. So at the retail level, we're not seeing a buying frenzy. So where's the buying coming from? It's coming from central banks. The big two, of course, are Russia and China. Russia, one of the reasons Russia has been able to withstand U.S. economic sanctions um, because of the war in Ukraine is they spent 10 years, actually longer than 10 years, beginning around 2009, buying gold. And by the time the war broke out in 2022, Russia had 25% of their reserves in physical gold stored in Russia. Their reserve position was around 600 billion, and they had 150 billion dollars in gold. By the way, the U.S. froze their treasury assets. They had in that reserve position, they had about $300 billion in U.S. treasuries. The U.S. Froze those, and now U.S. is stealing them to use as collateral for a loan to Ukraine, so Ukraine can fight the Russians. So basically, Russia earned dollars by selling energy, bought U.S. treasuries, trusted the United States. The U.S. stabbed them in the back, stole the assets, and used them to finance a loan to pay Ukraine to fight the war. So Russia's own assets are being used to fight a war against Russia. That's how crazy the world is. But what it means, if you're Saudi Arabia or Taiwan or Korea or certainly China, India, any other country that has large dollar positions, you want to think twice. I'm not saying people are getting out of the dollar. You really cannot get out of the dollar because there aren't any good alternatives. Do you really want to load up on, Italian bonds or German bonds, Japanese bonds? I don't think so. But gold, yes, not 100%, but at the margin. So Russia's U.S. treasuries were frozen, but its gold was not. This is the benefit of a physical asset. It's not digital. You don't need a wire transfer system. You just need a good vault, and Russia's very good at that. So that has really saved them economically to some extent in this war. So everyone's looking at that. So who's buying? China, Russia, India, Kazakhstan, Mexico, Philippines, Vietnam, Turkey. Some are more transparent than others. You can get this data. Just go to the World Gold Council website. You have to sign up. It's free, but you can find everything I'm talking about. I check it on a regular basis. So is retail at the frenzy stage? No. But are central banks buying? Yes. And that demand is increasing. So when you have constant supply, because mining output is not increasing, and higher demand from central banks, that's going to drive the price of gold higher. Now, the central banks are very smart buyers. They're not going to start a frenzy. They buy the dips. They take a little bit, say a little bit, a few tons, 5 tons, 10 tons a month. But it's slow and steady. So it's a very good trade for individual investors. It's what I call an asymmetric trade. I mean, no guarantees, but the downside is limited because of the central bank demand, but the upside is unlimited because central banks are going to keep buying. Eventually, we'll get to the frenzy stage. We're not there yet. So it's the kind of trade I like where, could you lose? Yeah, but probably not a lot, and you could make a lot. So it's a good trade in that sense. I guess the question is, when do we get to the frenzy stage? And there's a little bit of math. I always say it's sixth grade math, but that's when I went to sixth grade. I'm not sure what they teach today, but people think of gold in dollar terms, and that's right. I mean, that's the whole market is basically denominated in gold, and they think of $100 increments. So it just went literally in the past few days from 2,700 to 2,800 per ounce. Now it's above 2,800. That's an all-time high, by the way. It'll chug its way to 2,900 and eventually 3,000. So people look at those. But the math is interesting because as the price gets higher, it's basically in terms of percentage gains, forgetting about dollars, but percentage gains, it's $100 divided by the starting price. So 100 divided by 2,700 is a certain percentage gain, et cetera. But as the price gets higher, those $100 increments represent a smaller percentage. It's still $100. If you have 100 ounces and it goes up $100, that's $10,000 in your pocket. Nice going. But the percentage increase is smaller. So that means it gets easier. So, going from 3,000 to 3,500 is easier than going from 2,500 to 3,000. Both examples are $500 increments. But because the starting level is higher, the percentage gain is smaller, which means it's easier to do. So, I mean, there's no free lunch. You got to, do the math and figure out how much you're making in both measures. But in terms of capturing the public imagination, $3,000 is one of those thresholds, one of those psychological barriers. As an economist, you would say, so what? But as a analyst and a marketer and a investor, it's one of those critical thresholds. So I would watch for it to cross 3,000 sooner than later for the reasons we mentioned. And that's going to get a lot of attention because it's been in the 2000s for a couple of years. And then, boom, you might start to see people line up at the local gold dealer and say, get me some gold. Of course, by then it'll be hard to get. I always say, buy it now before your neighbors are lining up. But that's just human nature. People don't. But they will they won't buy it now, but they'll buy it when it's higher. So it's just human nature, but I would recommend buying it now.